Well, let's start today's webinar. So again, thank you for attending Business as Unusual webinar series, where we are talking with badass industry leaders who are helping us survive and thrive in today's economic climate. My name is Lisa Baining. I'm one of the account managers at Red Caffeine, and I'll be the moderator for today's session. We are extremely excited to kick off our 2021 webinar series with three experts in the financial and strategic markets to really give their insights on what they see 2021 bringing and how you can set up yourself as well as your business for success. As a few housekeeping notes, we do have everyone on mute today, so I highly encourage you to use the chat function or the QA option to ask questions of our panelists. We do have a lot of information to cover, so throughout the session, I'll be monitoring those two channels, and as appropriate, we'll insert questions, but otherwise we'll get to them at the end. So again, please use those, start the conversation. We love having this be an interactive session where everyone can talk and learn from and with each other. So with that, as I was mentioning as we got started, we do give out 5 $20 Grubhub gift cards to the first 5 registrants of our webinars, just our small way to give back to the restaurant industry in support of them. So again, today's winners were Wendy G, Tom H, Lori H, Landon J, and Jason B. With that, we'll go ahead and dive into our actual presentation, why we're all here today. So I'd like to introduce my co-host, Kathy Steele, who's the founder and principal of Red Caffeine, and also our panelists. We'll be hearing from Jeff Korzenik, who is the Chief Investment Strategist at Fifth Third Bank, Michael Rarey, Director of Investment Research at Capstrat, and Stephen Ryan, Director of Prairie Capital Advisors. So good afternoon to all of you. And with that, Kathy, you have the floor.
Yeah, welcome everyone. Again, I'm Kathy Steele, and I am the president of Red Caffeine, and it's our mission to build badass brands that people want to work for and with. And I'm so excited. There's so much content. This probably could have been a 3-hour webinar today, but we're going to try and boil it down, give you some high-level thinking, and then connect you with these great experts so that you can have deeper conversations. So I'm going to let the Mike kick it off and just give a little bit of a intro to himself and Capstrat.
Yeah, thank you. First off, thank you, Kathy. Thank you, Lisa, so much for putting this together. I'm really excited about the opportunity. So my name is Mike Rarey. I'm a principal at Capstrat, oversee our investment research and portfolio management. We're a fully independent registered investment advisor headquartered in Oak Brook, Illinois, with offices in Florida. And we advise on a little over 15 billion in assets.
And I'm Steve Ryan from Prairie Capital Advisors. We're a boutique investment bank where we help advise business owners as they transition their business to a current form, to either a third party or an internal transaction. We do about 70% of our transactional business is ESOP related, which is where we're founding. In addition to, we do about 400 valuations per year.
And I'm Jeff Korzenik. I'm the Chief Investment Strategist at Fifth Third Bank. I think most of you are probably familiar with Fifth Third. We are roughly the 10th largest bank in the country, and our 11-state footprint encompasses the traditional industrial heartland of the United States. I'm also the author of the forthcoming book, Untapped Talent: How Second Chance Hiring Works for You and Your Business. It's being brought out by HarperCollins Leadership. It's the first and only book of its kind. It shares the business case and best practices of hiring people with criminal records. This is an area of increasing importance and interest to the business community, not just because it solves labor shortages that we see coming at Fifth Third, but also because it's a critical pathway to the more socially just society and racial equity that we're all seeking. Thank you.
Yeah, Jeff, thank you for bringing up your book. So we wanted to give Jeff a chance to introduce that, but as a giveaway today during the session, for those of you that ask questions, the first 5 will actually be receiving a copy of Jeff's book. So just a little pot sweetener to be active within the chat or the QA option today.
All right, let's get started because we've got a lot of content to dive into. So Lisa, if you could go to the first slide, and we're gonna just kind of start off with Jeff. Jeff, where are the markets headed in 2021?
I think the context is very important. The stock markets tend to follow global growth, and we have had a big reset. The chart you see before you is a representation of what happens in recessions and then after recessions, what happens to GDP. The vertical gray areas you'll see in this chart are periods of recession. The blue shaded areas are how much GDP is negatively impacted. And then between those recessions, those towering green mountains are the growth of GDP that comes about after the recession ends. We should think of recessions as a chance to reset the economy and start another growth cycle. When you have larger resets, as we've had in the early months of the pandemic, it tends to set the economy up for long and sustained expansion periods. We think that's happening now. But if you turn to the next page, it's not going to be business as usual. We see the pandemic as this incredible disruptor. And it's not a traditional recession. The actual peak of the U.S. economy in February down to the trough of probably April or May was very short-lived, but it was very severe. This is something that is causing a large disruption across industries, geographies. We think it's going to disrupt employer-employee relationships. It's not all bad news. It's also an opportunity to address our supply chain. We'll talk a little bit about that later, I think. But we should understand that it's not business as usual. There were a number of trends in place in the U.S. economy. The pandemic has supercharged those trends, and that's going to have profound implications for what aspects of the market do well. We've already seen this in, say, the tech stocks, the work from home, study from home, get entertained at home. All of those stocks are already have already appreciated this. But we think that there's a lot more coming as a result of disruptive policies, as a result of the next step as this expansion unfolds.
Thank you. Mike, why don't you take us through, I love how you guys tee up your market reports. Why don't you take us through what this means from a private investment standpoint? What are you guys seeing for 2021?
Yeah, so when we create our investment outlook internally, we're always thinking in probabilities and scenarios. And when we do the annual outlook, we also like to tie these different scenarios to something that's more relatable. And so this year, what came to mind was the movie Back to the Future. Actually, a famous film just had its 35th anniversary. And the reason why that came to mind was everybody in 2021 really just wants to go back to how things were pre-pandemic. But the reality of the situation is things happened in 2020 that are going to permanently impact the future of how markets function, businesses function. And that's a lot of what we're going to unpack today for sure. So I'd like to walk through our different scenarios and the probabilities we've assigned to them. The first one, the base case, is what we call stuck at 87 miles per hour. And the idea there is there's the scene in the movie where Doc says to Marty, when this thing hits 88 miles per hour, you're going to see some serious stuff, expletive. And the idea there is, this year, we're going to make a lot of progress to getting back to the way things were, particularly around the virus with the vaccine effort. But we're not going to get all the way there. The virus is going to be something that we're going to have to live with in some way, shape, or form going forward. So, our outlook on the vaccine rollout and the virus is once we get towards somewhere around May, there should be enough vaccinations that have been delivered and taken that the over 65 population should basically been vaccinated if they so chose. And that's when the link between cases and hospitalizations and deaths should be broken somewhere during the springtime. And so that'll make the virus much more manageable. But that's just the first step. The next step would be getting towards herd immunity, and that's a much longer, a much taller hill to climb. So we're going to make progress there, but we're not going to get all the way there, most likely in 2021. And from an investment standpoint, that's okay. Because what has driven markets primarily in 2020 and is most likely going to continue to drive markets next year is not necessarily economic growth. The link between economic growth and markets has all but been severed, and that happened around April last year. What matters more is stimulus, and in terms of central bank stimulus and fiscal spending. And as long as the virus is still an issue, and any economic disruptions or market volatility can be tied back to the virus. We think that central banks and governments are going to feel compelled to provide more stimulus, and that's going to support valuations and support the market. So our base case, not getting all the way there, stuck at 87 miles per hour, but still a very solid environment for an economic recovery next year, as well as a solid environment for investing. And we obviously contrast that to our bear case and our bull case. We'll just touch on those quickly. So the bear case, in our view, the biggest risk to markets next year is actually not the virus or lacking progress on the vaccine. The biggest risk is central banks and governments starting to focus more on the long-term effects, long-term side effects of all of the stimulus that has been delivered and all the money that has been created. So if central banks and governments feel compelled to deal with longer-term issues such as the fiscal deficit, such as income inequality, such as wealth inequality, that looks like decreasing spending, raising taxes, signaling faster interest rate increases down the road, shrinking central bank balance sheets. Those things are bad news for markets. And if any of those were to happen, a lot of the valuations in the equity market just don't make sense. The numbers just don't make sense. So that's the biggest risk we're watching. And then finally, the bull case, 1.21 gigawatts of money at 10:04 p.m. That's the scene in the movie where you have to get the DeLorean to the clock tower at 10:04 p.m. because when the lightning hits, it'll pump it full of 1.2 gigawatts of power, which we know, of course, is actually gigawatts. And so you get this idea that, I don't know how much 1.21 gigawatts of money is, but it's a lot. And it's sort of everything's happening at just the right time. So the vaccination effort goes smoother than expected. We're able to reopen. Consumers and businesses feel very comfortable making up for lost experiences by unleashing pent-up savings and borrowings that they accrued last year. And you have a strong economic recovery as well as the market continuing to grind higher because central banks and governments even though the economic recovery is strong, still don't even think about pressing the brake pedal. So that's how we think across those three different scenarios. The next few slides, we have a couple supporting slides for that outlook. So this first one I want to touch on money supply growth. So this was the biggest chart for 2020. We saw in April and May that financial markets completely detached from the real economy. And the Fed effectively severed the link last year between the economy and financial markets. That link is the credit markets. And the Fed doing unprecedented things last year, not just the Fed, but other central banks, namely buying corporate bonds for the first time ever, severed that link. So what's more important now, in our view, for markets is not economic growth, it is money supply growth. The Fed and governments created money last year. This dark blue line is year-over-year growth in the US money supply, and we are at an all-time high, more than double the previous all-time high in money supply growth. And when money is created, but the economy is shut down and there's nowhere to spend it, it has to go somewhere. And that somewhere was financial assets. And that is what markets are focused on. Valuations now are expensive. All financial assets are expensive. As long as there is money being created, it will continue to flow into financial markets. So that's what we're watching. And as long as the virus is still an issue, money supply will likely continue to grow to sort of sweep that under the rug. So that's the biggest thing. We do expect money supply growth to continue next year, albeit at a slower pace, but still much faster than is required to support valuations. And the next thing, talking about money being created, now we're looking more on the consumer side at personal income. And, we can focus on the green line first. So that's personal income. This is the trend over time going back to 2005. And you can see personal income at the far right there peaked in April once the CARES Act hit and economic impact payments were distributed. So personal income, a lot of folks benefited from expanded unemployment benefits. They benefited from the economic impact payments, all that fiscal stimulus, and that definitely propped up personal income. So the economic downturn last year wasn't necessarily because there was no money to be spent. There was simply nowhere to spend it. And now we've gotten to the point where the underpinnings of this economic recovery have become so strong that if you focus on the blue line, now that's personal income, and we've stripped out the economic impact payments and expanded unemployment benefits, and that's still above trend. So this is a very bullish starting point for an economic recovery. You look at where we're at now in terms of personal income, well above trend. Most folks, so there's a lot of noise in this data, and we're going to talk about, I'm sure, the gap between the haves and the have-nots. But by and large, personal income is there, and it's a very bullish starting point. You compare that to 2008. It took 4 years for personal income to get back to trend after 2008. That was a problem of there are places to spend money, but there is no money to be spent. That's a much bigger problem. We don't have that problem this time. So as soon as the virus situation is taken into control, it gets under control and the economy is able to reopen, we think there will be a strong economic recovery. We hope it's not so strong that central banks and governments feel like they can like they should start stepping on the brake pedal. And the last thing I want to touch on is we know this money supply growth that has been unprecedented has totally distorted financial markets. And we're going to talk about valuations later, but we're going to take a look at valuations here for the S&P 500 in particular. And, you know, if you look at any number of valuation metrics for US equities right now, you're arguably top 3 most expensive equity markets in history. If you look at relative to earnings, relative to sales, relative to any measure, the only thing that is more expensive than US stocks right now are cash and high quality bonds. So that, in that sense, stocks still look attractive. So that's what we're trying to show with this chart. This green line is the earnings yield on the S&P 500 less or minus the 10-year Treasury yield. When this line is high, that means stocks look cheap relative to high quality bonds. And what you can see right now is, you know, that's called the equity risk premium. It's at 2.7%, which is reasonably attractive. Over the past 30 years, the average has been 0.9%. So stocks do look cheap relative to the alternative. So that's why you'll hear us say, Tina, there is no alternative. Money should continue to flow into equities. And when you have this disparity with stocks looking cheap relative to bonds, there are only a couple ways where this sort of normalizes. One is bonds get cheaper. That would mean interest rates would have to rise. That we think is virtually off the table this year, primarily because there's too much debt in the world. We cannot afford higher interest rates. The only time the fiscal deficit was this bad and debt to GDP was this ugly was after World War II. And that situation was so untenable that the Fed had to cap interest rates to allow the Treasury to roll over their debt. So we think interest rates rising, that's unlikely. It's in no one's best interest. So the path of least resistance here is just stocks get more expensive. And they can get plenty more expensive. If we go from a 2.7% equity risk premium down to the 30-year average of 0.9, that's about 66% upside in equities from these levels. So as long as interest rates are low, as long as money is being created and it has to go somewhere, we still think, Tina, there basically is no alternative to equities and valuations can get more expensive.
Thanks so much. I always appreciate that you really boiled it down because this is a lot to interpret, and I love how you connected it to something nostalgic like Back to the Future, one of my favorite movies. So let's step into, you know, you touched on valuations. Let's kind of step into that question set. So in 2021, we did really see how vulnerable our US supply chain was. What is your thoughts, Jeff, on where we're going to go with global growth? Oh, I'm sorry, I've got the wrong question. So
we can jump to that.
One thing, it's funny, kind of back to the 2021. You know, Prairie as an organization is a little bit different than certainly Michael and Jeff. They're looking at daily, daily, weekly, monthly, yearly volatility. We as a firm, as a transactional firm, we're looking longer term. We're looking at the markets as it perceives over a 7, for example, when we do a feasibility on a transaction, we're looking at a 7 to 10 year valuation, saying what is the business going to be worth over an extended period of time. So the volatility you're saying that they're talking about is not really what we're seeing. The one thing about 2021, if we're looking at it, is, you know, just for the stakeholders to just focus in on what it is they want to accomplish. And the one thing is, don't assume 2021 is going to be better than 2021 is going to be better than 2020. So that's something to be cautious about, because there are always unexpected things that may trip you up. an example. I was on a networking group today, and I heard that the Biden administration is talking about getting rid of the 1031 exchange for real estate. And that is an example, as Michael was talking about, some of those structural changes that can occur that can affect particular parts of the industry. So those are the things, expect that unexpected as you're kind of looking at the things that you want to accomplish. This chart talks a little bit about kind of the deal flow as we've seen it over the course of the last last 2 years. And as you can see, things were humming along in 19 going in until COVID hit. You saw some of the deals that were in the market that continued to close. Most of those that were the April and May timeframe were deals that expected to close, and they were typically really good companies. So from that perspective, these things that you're seeing here are companies that have been less impacted by COVID. In many cases, you are seeing some companies that are actually positively impacted by COVID. So as you can see, even in the throes of the pandemic, some deals were getting done. And now, as you can see that lineup, as valuations and as liquidity has gotten into the market, as Michael and Jeff had talked about, as that liquidity is in the market, we're seeing a nice ramp up of transactions for this year. So if we can go to the next page, talk a little bit about the multiples that we're seeing. And multiples have recovered since the dip, which is interesting. Is you would have thought that there would have been a bigger dip in this, and part of it is you're not seeing it as one. They're really good, healthy companies, so they haven't been quite as impacted by the pandemic as most. And most of those companies that have truly been impacted aren't being sold, right? Only good companies get sold. Those companies that aren't getting sold are the ones that are being impacted more. So when we get back, oops, I think we lost the slide.
I'll be back on in one moment. Sorry, a technical glitch there. So continue going.
The one thing about the slide and the multiples is a couple of things you can notice from that. One, size matters. The bigger companies are always going to be worth more than the smaller companies. But you also will look at, and I think the slide that we were trying to get to was really talking about some of the industries that were much more impacted by COVID. So anything that was related to travel or entertainment, where people were literally leaving their homes, going somewhere, those industries were truly negatively impacted. And you're not seeing transactions being done in those space, which means that part of the multiple that you would have expected a significant contraction in is because companies that are in oil, restaurants, those transactions aren't occurring, whereas all the other good companies are continuing to execute. And there is still a lot of liquidity. This kind of highlights some of the industries as we look at it, some that have been materially impacted, some of them that have been COVID proof, and some of the modest impact of them. And you are seeing some companies that have been weaker companies over the course of time that have actually turned it around during COVID. Some of the plastic manufacturers that are now making these plastic dividers. Those businesses were really, really struggling for a while. They've had a blip from COVID, but that's a temporary blip. That is not a permanent, sustainable recovery in that business. But those that reacted quickly have taken advantage of those things. So if you kind of go to the next chart. Oh, go back one. Go back two, please. So again, this gets back to the multiples that we're talking about, and then the size of the companies. We are actually seeing that this is actually going to continue to recover even more. We are seeing a significant amount of liquidity in the markets where the funds, the private equity, the strategics, and the family offices are all looking at trying to get and put liquidity at work. And there's a limited number. So you think of it supply demand, there's a limited number of companies that are actually out there that these higher amounts of liquidity are chasing. So we fully expect multiples to recover and be a really, really strong 2021. On the valuation side, talked a little bit about size matters in the valuation. That's why you get the higher multiples. The other industry multiples matter. So if you're really looking at, go to the next slide. These in between these industries. So if you're looking at technology, you're looking at grocery, looking at consumer products and cable, all those things that connect people to the lifestyle that they're living now, those multiples are being substantially increased over the course of time. In many cases, transactions that are in the market are getting reset because they're doing so well as it pertains to their business. And in many cases, the dynamics of that business has changed. When we look at some of the technology companies, I don't see that there's going to be a great change in people going back to the office quite as quick as you would expect. And some of those technology companies are benefiting as more and more people are doing Zoom meetings and Zoom webinars. And the need for that technology means cable companies are upgrading their systems. You're having to need higher flow through as it pertains to that. Microsoft is being able to charge for each particular location that they're selling their Microsoft products through, as opposed to bulking that together that they would do with a corporate side. So those are some paradigm shifts that are permanent within the industry. Let's go to the next slide. And one of the things that was asked about a little bit is about the PPP funds and how that impacts it. So this is just an example for people to just think about. So on the far left, you've got a company that had an enterprise value of 12.5. You take the debt down, you add back cash, you get an equity value, right, of 10.85. On shares of 100 gives you a 108.50. Now, that same business that has been it's been impacted slightly by COVID to the tune of 20%, which some people would think is a large impact. Some people would say, oh, that's not that big of an impact. But then if you carry that forward and carry it down, you have some similar factors within the business. They have less debt because they have less working capital. So they've repaid some of their debt. They have some less cash on their balance sheet because they've used that cash to pay down the debt. But the equity value is down to 8, to use an example, which means it's $80 a share, down 26%. But when you look at the impact post-COVID, because COVID is just going to effectively be the COVID, if you can get COVID forgiveness. So that's a significant barrier, because you have to actually first take the loan, get forgiveness of the loan for it to actually be added back to the valuation. So when you're looking at this, it adds an extra $15 a share, or 1.5, call it million, to the net bottom line, because it's effectively considered income. It's the forgiveness of principal, which would effectively be income from an accounting standard perspective. So when you're looking at that, instead of a company having a 26% reduction in the value, you're going to see about a 12.4% reduction in value. All else being equal.
So depending on where your business is at, like what top line sales are, and like if you're riding a wave versus there's a long tail opportunity of growth, it really, there's a lot of factors in play for valuation.
And the factors that as we look at it are those factors temporarily permanent? Yeah. So temporary would be a plastics manufacturer that can produce these glasses that are dividing the blackjack tables in Vegas, right? You got all these things there. So that's a temporary improvement. That's not a permanent paradigm shift. A company that's doing Zoom entertainment online, that may be a permanent paradigm shift in that business and may be able to carry that wave further.
Okay, makes sense. All right, now let's talk about our supply chain. I think this was something, we work a lot in manufacturing. We saw this really impact a number of our clients, both positively and negatively. And so, what are we going to see, based on that 2020 vulnerability that was created, and how our economy retools our approach to global growth?
I think that's the next slide. This is the multiple slide between strategics, strategics and knowable.
Yeah, let me take this, and I want to start out by sort of dismantling a myth that's out there, and that is that the U.S. lost manufacturing employment because of technology. Like many myths that persist, there's a kernel of truth. It is, of course, true that technology destroys manufacturing jobs, but it's been doing that for 200 years in the United States. And the way it has worked historically is that technological improvement creates productivity improvement, which creates more wealth, which creates more demand for manufactured goods, which creates even more manufacturing employment. And that's the 200-year history. When we lost manufacturing jobs earlier this century, we lost them because we lost market share. And that's the chart on the left. It shows you the sharp break in market share of global manufacturing employment that occurred with the opening up of China. As further proof that this was not just technology, think of technology as really a globally available good. If you look on the right-hand side, that's actual global manufacturing employment. It grew by 40 million outside the US, net out the loss of 5 million jobs in the US. It grew by 35 million. So manufacturing jobs didn't go away, they went abroad. And this is something where the Trump administration really did move the needle in the discussion of this. There's now bipartisan agreement that it is possible to be less reliant on China and in our supply chain for manufactured goods. And this is really a sea shift. This is something that's part of President Biden's Build Back Better. He has a specific Made in America proposals as part of his campaign, but ultimately it boils down in a large degree to the economics. And if you just flip this to the next slide, you'll see that these economics have changed. There was a time when it made enormous economic sense to send manufacturing abroad. Regardless of the security of the supply chain issues, it simply was overwhelmingly economical to do so. We take data from the Boston Consulting Group's Index of Manufacturing Cost Competitiveness. This is indexed to the US. So by definition, a reading of 100 means you're the same as US manufacturing cost. If you're above 100, you're less competitive than the US. If you're below 100, you're cheaper than the US. And we first started looking at the first 5 bars, the blue bars on that chart, and we said, well, where are the powerhouse manufacturing nations? If a company were looking to outsource manufacturing, where would they go to? And of course, you would start out by asking who has capacity. And so these big manufacturing countries, you can see that although China is still a little cheaper, and that was based on end of 2019 numbers, and it's likely changed towards being more expensive since then. You can see that there's no really cheap manufacturing left in countries that have capacity. We then looked at the nations that are in this Boston Consulting Group index. We said, well, what economies are still very cheap? And those are the 5 cheapest countries on the right-hand side there, those last 5 blue bars. And you'll see that although there are cheaper places to produce goods than the United States, it's not really overwhelmingly so. This is nowhere near what we would have seen, say, back in 2005 or 2003, when you would have seen China as a fraction of US manufacturing costs. So the economics have changed. Now, if you were going to go abroad, the cheapest country of the major significant manufacturing nations is Indonesia. This is not the same as going to a modern day China or a Germany today. There's rough edges to this kind of outsourcing. There will be winners. Maybe this is the time India's day in the sun comes. That's been a struggling manufacturing story for a long time. Mexico will certainly be a beneficiary, and that does flip back into supporting the US through nearshoring, and border states like Texas benefit from a lot of that. But we think the US will get some of these jobs back. You couple that with a focus on particularly the healthcare supply chain, in trying to diversify away from China, become less dependent. We think we'll see a renewed focus on bringing those jobs back to the US. The dollar appears to have topped, at least near term, and that's helping make US more competitive. We still have some real challenges in this area, though. We've lost some of the infrastructure in areas. We've lost so many manufacturing hubs over the last couple of decades that it's going to be hard to bring some of those back. Education is a big issue. We have a generation of parents who learn, don't send your kids into manufacturing. They should go to 4-year college degrees, whether that's a fit or not, because manufacturing jobs are going away. We have to re-educate not just students, but their parents as well, about the viability and really terrific opportunities for careers here, even if they're not a traditional 4-year college degree. And then we've simply lost some industry clusters. You know, the shoe industry used to be based in the United States. It's unlikely that we simply don't have the cluster to bring that back. But there's lots of areas: food manufacturing, metal fabrication, especially chemical manufacturing. All of these are vehicles. All of these are areas where the U.S. really has a deep expertise, a very, very robust infrastructure, and we should care about this. It's not to say we're not going back to 1948 America when half of all jobs were in manufacturing, but every manufacturing job we get adds quite a bit to the economy. Economists like to talk about multipliers. And it was traditionally thought that the multiplier associated with manufacturing activity was about 3. Every manufacturing job was associated with 3 jobs overall in the economy. Every dollar of value added in manufacturing was associated with $3 of GDP. Economists today believe that number is way too conservative and that the multiplier may be as high as 7 or 8 times. And it certainly fits. Manufacturing employment certainly is a great fit for people for whom a 4-year college degree is just not the right personal fit. These are great opportunities. So we expect a lot of focus on this. It's going to take a while. These things don't turn around on a dime. We lost this over a period of decades. It's going to take us a long time to bring some of that back.
So, Jeff, what about unemployment? So what kind of impact does that have on, unemployment in terms of, where we were last year with really an employee market and then how, where we are now?
Well, we're, pretty constructive on the long term for the U.S. economy, but what we are, and maybe, frankly, Michael, even a little bit more constructive than your very interesting outlook. But where we worry a lot is disruptions in the labor force. And there was an interesting article about 2 weeks ago on the front page of the Wall Street Journal had 2 side-by-side headlines. One said, we're suffering job losses. It was the December payroll number that came out in early January. And then the article next to it, the headline next to it said, we have a shortage of labor in manufacturing. So there seems to be this paradox going on in the labor market. And we think it's important to understand that the pandemic as this supercharger of trends is causing some real problems in labor markets. One is, and this is the one we show here in this chart, is long-term unemployment. This is the percentage of your unemployed who are long-term unemployed. That's 27 weeks or more, 6 months or more. And we're going up to the record set at back in 2010 when nearly half of everyone unemployed was long-term unemployed. That's significant because the long-term unemployed tend to not get back in the labor market, but drop out altogether. And that's a really unhelpful sign, but it's not the only area we've seen it. There's a skills mismatch. If you were a 50-year-old working in, retail in a department store, that job, if it goes away, may be offset with a job at an Amazon warehouse, but that doesn't mean that you're in the right geography or that's the right fit for you. Normally, these things go over much more gradual pace. The pandemic's accelerated it, and that's very disruptive for labor. We're also seeing it. There was a decline, a very troubling decline of women, particularly age 35 to 54-year-old women. We saw a decline in their labor force participation, very dramatic. We think it's associated with taking care of kids who can't go physically to school. These are very dangerous things for the labor force, and these are the kind of things that our growth is long-term very much tied to. And then, this is also of importance, thank you, because we are demographically challenged today in the United States. This is the birth rate in the US. And you'll see right in the middle is a spike up, a little peak, and that's the highest birth rate for decades surrounding it. That's the millennial birth boom. We've got those millennials. They peaked in, their birth rates peaked in 1990. Those are 30, 31-year-olds today. They're pretty much all in. We are running out of labor, at least domestically born, native-born labor in the United States. You can see this birth rate's declining. Demographers use another measure called fertility rates. How many children would women be expected to have over their lifetime? We are below replacement rate. We are not replacing our population. The only reason that the U.S. has kept a growing population is through immigration. But immigration is becoming not just politically a little bit challenged. Obviously, we're seeing a change with the Biden administration, but more importantly, long-term, the demographics of the world look very similar. China's fertility rate is well below the U.S. They're not replacing their population. If you go to the 30-odd nations that are part of the OECD, the Organization of Economic Cooperation and Development, those are the developed nations of the world. Every single country but one has a fertility rate below the rate needed to replace their population. The one exception actually is Israel, but that's a tiny country. I tell employers who are challenged for labor, there aren't enough Israelis to go around. We need a different strategy than counting on immigration.
All right. So let's kind of push forward. I would love to talk about, the notion pre-pandemic, there was a real push towards reimagining. Mike, do you want to give a little color here so we can get into the kind of reimagining capitalism? So there was really a push for companies to prioritize social issues alongside or over the stakeholder or shareholder value. So can you speak to what your thoughts are here?
Definitely, yeah. The traditional notion was that you can focus on environmental, social, governance type initiatives, but they are most likely at the expense of profits, financial performance, stock prices, et cetera. And that's just not the case. So we think, yes, companies will continue to prioritize these items, and no, they will not have to compromise, or it will not be at the expense of profitability and performance. So all we're showing here, there's been so much research. The research around the impact of ESG on financial performance for individual companies and stock returns has swelled and is quite significant now. And this study, it was basically an aggregation of all the studies around the impact of ESG initiatives on company financial performance. So over 2,200 empirical studies. And the bottom line is companies that focus on these things in all of these studies found that over 90% of them that actually improved their financial performance, or at least had a neutral impact. So this is very exciting for us. It's very exciting as an investor, and especially going out and picking investment strategies. Our clients are retirement plans, institutional non-retirement assets, so things like foundations, reserve accounts, and then individuals. And basically what this means to us is we can fully integrate ESG criteria into our investment selection process and create portfolios that align with each of our clients' values and initiatives, and not have to sacrifice on investment results whatsoever. So it's extremely exciting for us, to the point where, for example, we recently are in the process of working with a women's group, and we were able to create a portfolio where every investment in the portfolio, we know that manager proxy votes for gender equality. And that's just such a great value add. To know that we can do that without having to sacrifice investment performance is excellent. So this is not just a fad. It's not a short-term trend. There are generational tailwinds behind this as well that we think are very sustainable.
Yeah, I think we've felt it in the mid-market and seen it in terms of some of the groups that we're involved in, like Small Giants and books like Firms of Endearment. So I love that it keeps proving out.
And I'm going to jump in on this and tie this into the remarks I made about a shortage of labor in the U.S. This is going to be a huge issue. We have never faced a talent shortage, the likes of which we are going to face in the next decade. It's not just the demographics. It's not just the people we're losing through the pandemic. It's also a new Fed policy. The Fed's new monetary policy framework explicitly says they are going to let inflation go for longer and remain higher, and that they are not going to start normalizing monetary policy until unemployment goes down to 4%. In his remarks when he unrolled this policy in the September Fed meeting, Fed Chair Powell specifically referenced the good that red hot labor markets does for underserved populations. It helps bring about more income equality. It helps bring marginalized populations, people of color who had higher unemployment rates, helps bring them into the economy. So this is going to be a real challenge for businesses everywhere. And we think one of the ripest potential areas of underutilized labor are those who've been marginalized because of a criminal record. And one of the reasons we believe this is the numbers are just so extraordinarily large. The barrier I focus on is that 19 million Americans have a felony conviction. It's an astounding number, but you also have to understand that what you and I might think of as a felony, which usually involves visions of an axe murder, is not what it takes to get a felony today or over the past decades. Tellingly, fewer than half of those 19 million people were convicted of felonies of such risk to public safety that they even had to be given a prison sentence. So most people who get felonies don't even go to prison. And it tells you a lot about sort of the over-criminalization we have. There's famously in Florida a case of a man out with his fiance, and he brought heart-shaped balloons, and they were sitting on the beach, and he let them go into the ocean. He got charged with a felony, an environmental crime. I know a young woman in New York, age 19, out on a date. She got caught with 2 fake IDs in the state of New York, 2 fake IDs with intent to defraud, like getting a drink when you're underage. She was charged with a felony. So there's this long history of abuse of the system that has barred people from fully participating in the economy, and yet these aren't people of who we should be overlooking. None of this would matter if we didn't have proof that this can work. There are a number of pioneering companies and institutions, Johns Hopkins Hospital System, notably, and many small companies, as well as companies like Georgia Pacific or Virgin Airlines, who have all focused on hiring from this demographic. And they've all found that if you have a process in place that does it right, namely finds people who are ready to turn their life around, and then critically you provide them with some support tools. It might be mentoring, it might be assistance with problems of poverty like transportation assistance, or simply a manager who understands these challenges. You get not just an employee, you get an exceptionally engaged and loyal employee. So it's a really important area. It also fits very well with the demand consumers are having for companies to be part of the solution in the United States. And finally, we see, particularly with the millennial generation and the generation that's after them, they want to work with companies that are helping solve societal problems. So this is just one area, but it's one that, I know a book about it is coming out too. And I think this, just given the numbers, is a very important area to look at.
And then I think we'll let Steve bring it home, talking about employee ownership.
So when you're looking at reimagining capitalism, and you're looking at, what is capitalism, right? Capitalism is individuals investing and creating as much wealth as they potentially can and maximizing that return. The one kind of core about ESOPs, and ESOPs have been in place since the early 50s, right? Mid 50s is when Kelso had kind of founded the foundations of ESOPs, and it's ebbed and flowed over the course of time. But effectively, what an ESOP does is it takes the economic risk and return of a business and takes it from an existing owner, and let's call it one shareholder to be simple, to that economic interest goes to all the employees. And it's one of those that it's a non-discriminatory plan where all the employees benefit on those economics. And so it is an example of the way of rebalancing and reimagining capitalism that has support from both sides of the aisle. So it's probably one of the few things that both sides of the aisle can agree upon, is creating wealth for more is better than creating wealth for fewer. And so we are seeing a significant increase in demand and people exploring it. They can be complicated, and it is governed by ERISA, and there's all sorts of regulations around it. But at its core, it's a way of actually bridging the wealth gap between the haves and the have-nots. Because effectively the haves that own 100% of a business today, that economic interest is going to go to those employees that are probably more likely have-nots. Many cases, most of those are manufacturers or people that probably from a savings perspective tend to save less for retirement than others. One of the negative things that people say about an ESOP is that, you got a concentration of ownership in one share. I would argue you have a concentration of one stock, but you have a 401k that also supplements that. And an ESOP in and of itself is not funded by the employees themselves. The company actually funds it and pays it. So it's a benefit offered to employees from the cash flow of the business. And that's why there's so many tax advantages for ESOP related companies. But as more and more of these occur, you may see a reimagining and rebalancing of how capitalism works within the country.
Yeah, Steve, I'm just also going to jump in. There was a really interesting headline that I've looked into a little bit. There's a publicly traded company, a NASDAQ company, Aviva Systems. It's a healthcare company that their shareholders elected to become a public benefit corporation, stating that it's not all about profits, it's other things. So these trends, I'm a big fan of ESOPs, and all these trends I think are going to accelerate in the next couple of years.
And I think that's the younger generation really saying, this is important. Jeff, take no offense. It's you and I that are older. It's Michael that's younger that's going to promote the change that we need in our country. And that's the thing that you've seen over the course of the last year. I mean, of anything that's occurred in the last year, we've actually seen good positive momentum to the change that we need to do as a country.
And I, in my own company, being financially transparent, just being able to see that financial acumen built for our employees that you don't necessarily get from your company. So an ESOP is a way to educate, to improve, everyone's life. I completely agree. So Lisa, I know we've got a lot of questions, and I know Jeff got a hard stop at 2. So let's get some Q&A going.
So Jeff, I know you saw the question and let me know. We had a question about our newly appointed Treasury person, Janet Yellen. Any thoughts to weigh in on how you think she'll perform in her role? And then I know you need to jump to your next engagement.
So I'm part of the Yellen fan club. She was a great academic economist. I think she was a great Fed chair at a difficult time. And I have high hopes that she'll be a great Treasury secretary. But I think it'll be very important for all of us who are observers of the markets and the economy to understand that she's got a new role. As Fed chair, she had a very high degree of independence. As Treasury Secretary, she's representing the administration and a political need. She's perfectly capable of it, but I would offer as proof of this that she was talking about the need for stimulus. Part of the administration stimulus plan is an additional payment to households, adding on to that $600 December payment, bringing it up to $1,400. And that can be very high because it's per working person and dependent children. So this is a big windfall for middle earners. Interestingly, Christina Romer, who was the chair of the Council of Economic Advisors under President Obama, recently talked about what a bad economic idea that is, how poorly targeted it is, how much we need relief in other sectors of the economy and not just giving money to people who have been unimpacted by the pandemic. Yet I have every confidence that Janet Yellen, the great economist, understands this, but she's going to be out there in front as the administration's spokesperson in many economic matters. She's going to be advocating this. So I think we have to understand she's no longer an independent actor and treat her statements with that context.
So would that be Back to the Future, an alternate novel, right? Isn't that kind of, back, but it's going to be a different norm.
One other, Yellen related thing is you couple Yellen with Powell's new monetary economic policy framework and the intention of trying to create red hot labor markets. Yellen in 1990 was the co-author of a very famous paper, kind of the seminal paper on this called Waiting for Work, which says that to get people from the sidelines back in the labor force, it's not just a matter of jobs being present. You need a red hot job market. And so I think that Treasury and the Fed will be very much operating in concert to develop this. That's great for, underserved populations. It's going to be very challenging for employers who have to manage compensation costs and have talent needs.
So maybe more stimulus for businesses. Like, I felt like the PPP was nothing I had seen in our lifetime in terms of how the government's reacted to business, and helping business elevate.
I think she'll be advocating for that because that is on the administration's agenda. Whether that goes through, I think there's going to start being some real pushback as people start asking, how is this money ever going to be paid back? And realistically, by the time you start getting into a lot of these debates, a couple of months from now, you're going to see, and Michael referenced this, with the vaccinations, this is going to become a nearly non-deadly disease. And with lockdown fatigue and all that, I think a lot of consumers are going to start going back to getting out and about and spending that very high savings rate we've seen. So I think the urgency will start going away a little bit.
Yeah, no doubt. Pent-up demand we're all hoping that is accurate, and we're going to see a real elevation come May, June.
And the original PPP was put in place as a bridge, right? It was throwing liquidity instead of people going on unemployment and companies, letting their people go and then do it. It was a way of pre-funding, that unemployment so people will continue to work, and that putting that liquidity continued to have people have a positive impact and positive understanding. FDR had talked, the only thing we have to fear is fear itself. Well, this created so that people didn't have that fear that I wasn't going to have a job, I wasn't going to have so I think that was the initial intent of PPP. But then I think that's evolving now to where it is today. And I'm sure Michael's got more of his thoughts on that.
Yeah, with relation to stimulus and tying it back to Janet Yellen and the unprecedented actions that we've seen, the CARES Act was far different, larger in terms of magnitude, scale, and targeting than any other fiscal stimulus we've seen, trying to tie that all together. If you listen to Janet Yellen on Capitol Hill 2 days ago, she was very much in favor of more stimulus because interest rates are low. So it's very much foot on the gas pedal, which we think is very constructive for financial markets and money creation. And then also, we think it's so important now that Treasury and Fed have never been more codependent. Fiscal deficits started to actually dictate monetary policy in 2018. And now monetary policy is reliant on fiscal spending in order to increase economic growth. So these things are, and it's to the point where the Treasury actually has $1.4 trillion sitting on the Fed's balance sheet right now. So it's very important that they're working together. So getting someone at Treasury that has Fed experience, now it could never be more important than it is now.
Well, I told everybody that this could have gone 3 hours. I definitely would. So want to thank Jeff. I know he's got to exit. Give everybody a heads up on our how to get in touch with our panelists if you want to have a one-on-one conversation, and then our next speaker in February.
Yes, so as I bring this screen share back up, for those of you that did have questions, what I'm going to do is send those out to our panelists to see if they'd like to weigh in. We will be sending up a follow-up email. So as you see on the screen now, we do have their contact information, so you can also reach out to them directly, but I will funnel the questions. So Ken and Lori, I have yours captured. So I apologize, we didn't have time to get to it. There's so much great content today, but we'll make sure that those get answered and follow up and also shared out with our entire audience. So again, you can reach out to our three gentlemen with any questions you have. Just make sure you reference as a business as unusual in that subject line so they know you're coming from the webinar. As we look ahead to next month, our next webinar will be on February 18th. It'll be featuring Doug Farron, as you can see on the slide, Managing Director, at the National Center for the Middle Market. This is going to be another powerhouse session, just as you saw with today. So Doug's going to be digging in more on how the middle market, when we look back to our previous recession a decade ago, really helped buoy our economy. So as we're in this pandemic and as we talked about today's supercharged trends, how is this in the middle market segment, what is the potential for having that segment of business really help us recover? So we're going to hear more about an actual study, the 2020 Middle Market Indicator Report, which Doug was a part of. So we'll be walking through that trend report, as well as touching on a few other areas that weren't included, like diversity, equity, and inclusion. So great themes. Stay tuned for more info. We'll have the login information and sign up information included in the follow-up email you'll be receiving for this. You can also visit Red Caffeine's website. Right on our homepage, dead center, you'll see the Business as Unusual Business Series. You can go ahead and click on that to go ahead and register. If this was your first Business as Unusual webinar, what a great way to start off 2021. So again, thank you to our panelists, Michael, Stephen, and Jeff, as well as Kathy for today. If you have any questions about how Red Caffeine can help you with your go-to-market strategy, feel free to reach out to us at connect@redcaffeine.com. So again, thank you everyone for attending and enjoy the rest of your day.